Okay. I think we have just over 45 minutes. We're going to skip this problem. You're going to be okay without it. If we have time in the class today, we'll go back to it. But there's other stuff that's more important. So we're going to skip this problem right here. But we will talk about this stuff right here. Most companies use a straight line for all or some of their assets. Why? For a number of reasons. It's easy to use, easy to explain, smooths the expense recognition. In other words, you have the exact same expenses every period. In general, managers like smooth earnings. They like consistency. Straight line depreciation does that for them. So most firms use straight line. Compared with any other kind of method, straight line is the slowest possible depreciation method. You're going to have the least depreciation in the first year using straight line than anything else. You cannot depreciate it slower than straight line. Another way of saying that is you cannot have a de-accelerated method. That's not allowed. You can only have an accelerated or even, which is straight line. You cannot go slower than straight line. So for many firms wanting to look good today, the straight line method is going to make their net income the highest today that is possible. I'm simplifying that a little bit, but we don't have time to get into the details, so we'll just stick with that for now. Companies are allowed to use different depreciation methods for different assets, so many firms use straight line for most of their assets, and then some of their technology, they use an accelerated method. It's a pretty common thing for firms to do. We're going to skip this. This is depletion, and we won't worry about that. We have some other topics that we make sure we get to. Amortization of intangible assets. So, as we've been talking about depreciation, we've really been focusing on tangible assets. Property, plant, and equipment being the one that we usually think about. But we need to think about how do we spread the costs of intangible assets over periods of times as well. And that's where we get amortization. It's basically the same thing as depreciation, only for intangible assets. For intangible assets, we basically have two categories. Ones with finite lives, ones that are basically going to have useful lives, and then they're no longer useful. And ones that do not have finite lives. They basically go forever, and they never end. It's really hard to spread a cost over infinity. And so if that's the case, if the useful life is infinity, then we do not amortize it. So only when we have a finite useful life do we amortize. So intangibles subject to amortization are intangibles with a finite useful life. Examples of these would be things that have legal lives, like patents, copyrights, and franchises. All of those have a period of time over which you have that legal right, and then it goes away. And so that's the useful life of those particular intangible assets. And you're going to amortize it over that period of time. Amortization is almost always done straight line. As far as I know, you're not allowed to do it any other method. So straight line is what you do with intangibles. Intangibles not subject to amortization are intangibles with an indefinite or an infinite useful life. Examples of that is goodwill and trademarks. Trademarks never go away. If you have a trademark, you will have that forever in the future. There's not a period of time after which you lose that trademark. Instead, we rely on periodic testing for impairments to make sure these assets are not overvalued. But we do not amortize them. Prior to about 15 years ago, we did amortize goodwill over 40 years. That changed about 15 years ago, maybe a little bit less than 15 years ago. And now we do not amortize goodwill. We put it on our books and it stays there forever unless it gets impaired or you sell the company that you purchased previously. Straight line method is almost always used. All right, so that's intangible assets. The two big topics that we have remaining, which we will spend the rest of our time together, which I think will be just fine for the 45 minutes that we have, are two different types of impairment tests. And I'm going to warn you that They're both impairment tests of assets, but they're different, and you need to separate them in your brain, otherwise you're going to have problems. The first one is an impairment test for property, plants, and equipment, or in other words, a tangible asset. An impairment test is basically a test to make sure that you do not have an asset on your books for more than what it's actually worth. We've already seen an example of an impairment test. What is the impairment test we've already seen? Lower cost or market. And that is specific to what type of asset? Inventory. So inventory's impairment test is called the lower cost or market rule. The test for long-term tangible assets, like property, plant, and equipment, this is the method we're going to do right now is the method we use. We don't use the lower cost or market rule, that's just inventory. This method that we're going to do is called an impairment test on long-term assets or long-lived assets, and that's the one we're going to say. For most long-term assets, the impairment test is done whenever there is a triggering event. So, for example, for property, plants, and equipment, you don't have to do an impairment test every period. The only time you have to do an impairment test is when something tells you that the asset might be worth less than what it's on our books for. A good example of a triggering event is when a building burns down. It's probably suddenly worth a lot less than it was previously. Don't you think? Right? That's a triggering event. But there's less dramatic triggering events as well. For example, if you're talking about real estate, if the entire market for real estate goes down, the value of all real estate goes down, that could be a triggering event. You may want to go and then check to make sure that your assets are worth at least the amount that you have on your books for. Other triggering events could be industry specific. If the demand for a particular asset goes down significantly, or the value of an asset goes down significantly, and you have some of those, you might want to go do an impairment test. So there's a variety of triggering events. They can be specific, or they can be very broad, like market changes. All of those can be triggering events that tell you you need to go do an impairment test on these specific assets. This is how the impairment test works. There are 2 steps. Step number 1, I'm going to read through this and then I'm going to try to help you understand it. Step number 1, you're going to determine if a write-down is required. A write-down is required when the current book value of an asset is greater than the undiscounted total future cash flows. You got all that? No. Okay, so there's 2 numbers here in step number 1. The first number is the book value. What is a book value? Historical cost minus accumulated depreciation. That's our first number that we need. In other words, the amount that it shows up on our balance sheet for. That is the first number that we need. That is the current book value. The second number we need is the undiscounted total future cash flows. All right, so all of you have taken Intermediate 1. The reason you have to take Intermediate 1 before this class, part of the reason is that you learn time value of money skills. So undiscounted total future cash flows mean we look at this asset, we estimate the cash flows associated, they're going to come in from this asset over its useful life until we get rid of it. We estimate all those assets, and we just add them all up. No discounting. It doesn't matter if we're getting cash flow today or getting cash flow in 50 years. We just add all those numbers up. That is the undiscounted total future cash flows. We're ignoring time value of money to get this number. And we'll talk about why in just a second. That's step number 1. If the book value is greater than the undiscounted total future cash flow, then we're going to have an impairment. If it's less, no impairment. We're done. Go home. You don't have to do anything else. If we do have a write-down, step number 2 tells us how much the write-down is going to be. Step number 2 says to determine the amount of the write-down is going to be measured as the book value, so the same number again, that book value we already talked about, minus the fair value of the asset. Okay, so this is a new number. What is the fair value of an asset? Okay, so if you have a market, that's the first place we look. If we have a market, we go there and we determine its value from a market. What if we don't have a market for this particular asset? What if it's a piece of equipment? There's usually not markets for specific pieces of equipment. What do you do then?
Estimate.
Okay, and how do you estimate? You're right.
Compare them similar.
Yeah, comparison.
Okay, you could compare it to similar. That's not the most common way of doing it. Think finance. How does finance determine the value of things? What's that? The present value of future cash flows. This is usually how most of these assets are determined at fair value, is by taking the present value of future cash flows. If you have a market, you use that, but if not, you usually use the present value of future cash flows. So talk to your finance buddy and he'll show you how to do it. Just kidding. We all know how to do it too. So the fair value of the assets, fair value is based on the market price of the asset or the discounted present value of future cash flows as I have there in the brackets. All right. I'm going to do a little picture here on the board, because I like to draw pictures. And I'm going to help you understand why we have a two-step process. There's a very specific reason why this is the rules that we follow for impairment tests. It's not just some random thing we choose to do because it's fun and we're accountants. No, there's reasons behind what we're doing here. So, first of all, we need to think about these three numbers. We have a book value, an undiscounted total future cash flow, and a fair value. For now, I want you to think about the fair value as the discounted future cash flows. That's usually how we determine this number right here. So, undiscounted future cash flow compared to discounted future cash flow, which one is going to be bigger? Undiscounted is going to be bigger, right? Because as you discount things to today, they get smaller. Because they're going to grow into the future, right? So we have this top number, which is our undiscounted future cash flow. And then we have this lower number, which we're going to call the fair value. And by definition, it will always be lower than the undiscounted future cash flow. By definition, 100% of the time it will be. Unless you expect all the cash to come today, that would be the only time that it would be the same. Otherwise, they're going to be different. And this number is going to be bigger than this number all the time. Okay? Undiscounted future cash flow, fair value. Now the book value can fall one of three places. It could be above both of them, in between them, or below. But these are always going to be like this. This one's going to be the top, this one's going to be the bottom. So let's assume for a second that our book value is up here. So if our book value is above the undiscounted future cash flow, we go to step number one, and we say, write-down is required when the current book value is greater than the undiscounted total future cash flow. Is the book value greater than the undiscounted future cash flow?
Yes.
Yes. So in this example, we have an impairment. We'll talk about how much in just a second. If our book value is here, do we have an impairment? No, because step number one says only if this number is greater than this number is there an impairment. What about if the book value is down here? Do we have an impairment?
Yes. Yes.
No.
No. Only if this number is greater than this number do we have an impairment. Step number one says if the book value is greater than the undiscounted future cash flow, we have an impairment. So we definitely don't have an impairment with down here. We don't have it in between them either. We only have an impairment if the book value is greater than the undiscounted future cash flow, okay? So book value down here, no impairment. Book value in between, no impairment. Only when the book value is some number greater than this one, we'll say it's right here. If our book value is greater than the undiscounted future cash flow, do we have an impairment? And then we figure out the amount. The amount of impairment is going to be the difference between the book value and the fair value. In other words, if our book value is right here, we're going to mark our value of our asset down to this number. Let me give you some numbers to help you think about this. Let's say this is 6, 10, and 12. We have this asset on our books for $12 million. The undiscounted future cash flow is $10 million. The fair value is $6 million. Go to step number one. Is there an impairment?
Yes.
Yes, because the 12 is greater than the 10. How much is going to be the impairment? It's going to be 6, because we're going to mark it from the 12 down to the 6. That's not what you thought?
And wait, so yeah, down to book value minus fair
It's going to be the book value minus the fair value. We mark it from the 12 down to the 6. So when we're done, the new book value is 6. That's what it ends up being. Okay. Now, this is a hard question, but one of you is going to figure it out. What is these, with these numbers, ignore this number, let's say the book value can be any number. If our fair value is 6 and our undiscounted cash flow is 10, what is the smallest possible impairment for this asset?
6.
No. Also no. Well, maybe.
1.
Not 16, not 1.
4.1.
4 and a cent. Okay? So 4 million plus 1 cent. Why? Because let's say the book value is 1 cent less than 10 million. Step number 1, do we have an impairment? No. If the book value is less than this, no impairment. What if the book value is 1 cent above this?
Yeah.
Yes, impairment. And then what do we impair it down to?
6.
6. So the impairment would be 4 million plus 1 cent. So the smallest possible impairment is the difference between these two numbers. You could never have an impairment smaller than that amount. Not possible. Okay, so now, normally I would ask you, well, why are you doing this, but we don't have time. So I'm just going to tell you. Yeah, going fast kind of throws off my rhythm. Normally I'd be asking you questions all through this, but we don't have time. So the reason that we have these two different numbers is so that only significant impairments happen. In this case, we're saying significant is $4 million. We cannot have an impairment less than $4 million in this example. Step number 1, make sure that is the case. So the minimum impairment in this example is $4 million. In more general terms, the minimum impairment possible is the difference between the undiscounted cash flow and the fair value. So we'll just change some numbers, see if that makes any difference. If this is 2 and this is 5, what's the smallest impairment possible? 3, right? Step number 1 is what makes sure that we only have significant impairments happen. In other words, if the value of something goes down 1% because of normal valuation changes that happen all the time to every asset, we don't impair it. We only impair it when it's significant. That's what step number 1 does. That's the purpose of step number 1. The journal entry, when we actually impair something, is this. Debit to some kind of impairment loss and a credit to accumulated depreciation. Crediting accumulated depreciation is going to reduce the book value because you are getting rid of some of that book value by increasing the accumulated depreciation. We only write assets down. We don't ever write them back up. We cannot restore previously recognized impairment losses. This is an example of accounting conservatism. We only go one way with this, down. We never go back up. Very briefly, I will describe how this is done internationally. There are 2 significant differences between how we do this in the US and how they do it internationally. The first is that internationally it's a 1-step process. Step number 2 is the whole thing. Basically, they get rid of the requirement for only significant impairments to have happen. They get rid of step number 1. In other words, if you had an asset that was 2.1, the book value was 2.1, you would impair it from 2.1 down to 2 under the IFRS rules. So you can have much smaller impairments happen under IFRS. The second big difference is if you have an impairment in one period and the value goes back up, you can recoup those and have gains in future periods. So you can recoup losses that you had in past periods and bring those back and have gains in future periods. So those are the 2 big differences internationally compared to the way we do it here in the United States. So let's do an example. Yeah.
What if the market price is higher than the discounted present value?
Not possible.
As in,
Not possible. Because if your market price were greater than this number, then that means you couldn't sell it. In other words, if you switch these two,
no, the market price is greater than the fair value because you said that the fair value could be either market price or the discounted present value of the future cash flow.
You use the market price, but it's still gonna be lower than this number, that's the key
Yeah.
point there. But yes, you use the market price, because it is usually a better way of estimating something than a discounted future cash flow. It gives you a better idea of what it's actually worth. Yeah, so you prefer that number. I thought you were saying, what if these two were switched? No, can't happen, I promise. All right, here's my example. Example 1. West Technology Inc. acquired a machine for use in its computer chip manufacturing operations in 1998. Obviously, I've had this problem for a long time. At a cost of $35 million, the firm expected the machine to have a 7-year useful life and 0 salvage value. So this problem is actually going to do 2 things. We're going to do an impairment test, but we're also going to do a change in depreciation because of the impairment. We don't have a separate problem for change in depreciation methods, though there are homework problems that ask you to do that. This is our one example that we'll do here in class. So hopefully you can get it from the textbook and from this one example. All right, so 1998, bought it for $35,000. The firm expected the machine to have a 7-year useful life, 0 salvage value. The company is using straight line depreciation for the asset. Due to the rapid rate of technological change, the beginning of the year 4, the firm estimated the machine is capable of generating undiscounted future cash flows of $17 million. So that's that first number that we need, $17 million, and will be disposed of at the end of year 6. Based on the quoted market prices of similar assets, the firm estimates the machine to have a fair market value of $14 million. That's our fair value that we'll use. Number 1, should the company recognize an impairment of the asset? Why or why not? If yes, what is the amount of the impairment loss that should be recognized? Excuse me. So the first thing we need to do is identify the 3 numbers that we need. Book value, fair value, undiscounted future cash flows. 2 of them are given to us, 1 we're going to have to determine. The book value is not given to us because we acquired it and we depreciated it for a period of time. We need to figure out what is the current book value. We have held it for how many years? We are now at the beginning of year 4. So that means we've held it and depreciated it for 3 periods. So we're going to take our $35 million, 35 million, no salvage value, so minus 0, and divided by the number of years of useful life, which is 7. We're going to depreciate it each year, 5 million, and we're going to depreciate it for 3 years, which is going to give us, I'm not going to write the zeros because I don't want to, 15 million over those first 3 years. It is now the beginning of year number 4, and so our book value is going to be the 35 minus the 15, which gives us a book value of 20. Is everybody okay with that number? Okay, so our book value is 20. In fact, I will write it up here. Our fair value is 14. Our undiscounted future cash flow are 17. And our book value is 20. Those are the numbers that we have in this problem. The way that you want to write this down is to show that you understand the 2 steps. So this is the way that I highly recommend you write it down on the exam. You're going to write step 1. In step number 1, you're going to make a comparison between the book value, which is 20, and the undiscounted future cash flow, which is 17. The book value is bigger, and then you're going to write something like therefore, or I'll write therefore, whoops, I will not spell it right, therefore, it's an R, not an F, I promise. Therefore, impaired, because the book value is greater than the undiscounted cash flow. That number is bigger than that number, therefore, it's impaired, exclamation mark. Okay, I'm very excited about this impairment. Oh, actually, be back up for a second. What's our triggering event?
Technological change.
Yes, very good. Rapid rate of technological change. That tells us we need to do an impairment test. Then we go to step number 1. Step number 1 says, yes, there's an impairment, and step number 2 will tell us how much. In step number 2, we're going to compare the book value of 20 to the fair value of 14, and that is going to give us an impairment of 6. In other words, we're going to mark it from the 20 down to the 14 with a loss of 6. The journal entry will look like this. We will have a loss of 6, and we'll have accumulated depreciation be increased by 6. Looking at this example, ignoring what our book value is, what is the smallest impairment we could possibly do?
3.
It's 3, very good.
That's the point.
So if the book value were just slightly above the undiscounted cash flow, we'd have an impairment of 3. We can never have anything less than 3. It's not possible. With these numbers anyways. All right, any questions about that portion? Okay. The second part is going to ask us about a change in depreciation estimate. So some things have changed, so we can't continue to depreciate it to $5 million each year, right? Our book value has changed, and it says in the problem that we think we're going to dispose of it at the end of year 6, not the end of year 7 anymore. So when we do a change of depreciation estimates, it's a change of estimates, which we do what we call prospectively. In other words, from here, moving forward. We don't go back and change what we've already done. We just say, with the new information, we're going to depreciate it differently from here on out. So what we're going to depreciate is what we have left. And what's the book value that we need to depreciate? How much do we have left that we need to depreciate this asset? 14, very good. Because we depreciated it down to 20, but then we impaired it by 6, so our book value is now 14. So 14 is what we have left to spread over however long we have left. And how many periods do we have left?
3.
We have 3 years, because 3 years have passed, and we think it's going to be a total of 6 years now, not 7. So we have 3 years remaining. So we divide this by 3. We're going to depreciation in each of the last 3 years of 4,666,667. Any questions about that?
Is the 14,000 or million?
14 million?
Is it,
Right, yes.
is that, that's the.
Fair value. Oh.
But it's also book.
It's the fair value, and then after we do this, it's also the book value.
Okay,
They're equal after that.
okay.
Yep.
And there's no, we decided there's no
Salvage value.
salvage value.
Correct.
Right, yeah.
So we didn't have to subtract anything from the 14.
3 years left, okay.
We got it. All right, example number 2, we're going to redo example number 1, except we're going to assume that the future undiscounted cash flow is now 21 instead of the 17, and the fair value is now 17 instead of the 14. We'll do the exact same impairment test. Step number 1, the book value continues to be 20. The undiscounted future cash flow is now 21. Therefore what? No impairment. And you're done. So, I don't want to make you self-conscious, but when you get to the exam and you have a problem, and it ends like this, don't freak out, because it might be right. And if it ends like this, don't freak out. It's going to be one or the other. But if it ends like this, you're going to feel like you didn't do enough work. But it could still be right. Okay, so that's my. I could go either way. I could have it be an impairment or not. So be prepared for both, I guess is what I'm saying. Either way, if step number 1 is no impairment, you don't have to do step number 2. You're done. But if there is an impairment, you have to know how to do step number 2. So be prepared with both. Sound good? All right, and we continue to fly.